Hello, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for March 21st of 2022. Please see our disclaimer for important information. As we get started this week, obviously we want to revisit our high frequency indicators. You can see here data is mostly positive. I think we are beginning to see a little bit of demand destruction with regard to high energy prices and gasoline. You can see the supply of motor gasoline dipping ever so slightly in the last weekly data. You can still see it up month over month, as you can see really most of some of the discretionary items that we follow on an active basis. So open table restaurant industry sales, up both in the week and the month. TSA checkpoint data also up, as well as hotel occupancy. Restaurant industry data is actually pretty interesting because of some of the cost inflation that we're seeing in some of the restaurants now. Global commercial flights down slightly over the week, but up strong, reasonably strong over the month. And you can see in the red numbers there where these current data points lie relative to the pre-pandemic era, and we continue to close that gap in most of these categories. Now, obviously, steel production, rail car traffic, a little bit off in the week and the month, even though manufacturing is still reasonably healthy. We have had the supply chain choke points that have kind of bear down on that lately, and I think we do see a softening, if you will, in intentions to make durable goods purchases on the part of consumers that are fighting the inflation headwinds. Good news on the labor front continues to improve. We see continuing jobless claims now at a new recovery best. Here are some of the components of that. You can see weekly retail sales, hotel occupancy, TSA checkpoint, and open table. And this is just a graphical representation for people a little bit more visual on these things. Kind of this aqua line you can see in the left-hand side of all of this represents the 2022 data year to date. You can see where we're starting off on weekly retail sales above the trend, open tables like literally right on top of the 2020 data, TSA checkpoint, again, continuing to recover, still a little bit below pre-pandemic levels, and then hotel occupancy really pushing forward. Now, obviously, the things that we're monitoring on various components on this slide, hotel occupancy, obviously, how much of this is leisure versus business travel. We do think business travel is going to take a while to recover. That also impacts TSA checkpoint. Open table, again, we're talking about cost inflation and the fact that that's been reasonably strong. We have seen a dip here in March, I think ostensibly because of that. And then retail sales, I think, are heavily influenced by gasoline purchases. Here's a quick look at initial jobless claims. You can see if you back out the red and the black, which represents 2020 and 2021, those significant anomaly there. But if you look at the rest of the prior 10 years, you can see the kind of the seasonal trend lines and where we stand relative to that. So initial jobless claims are exceptionally low relative to the 10-year average here. As you can see, we do know that labor is strong, unemployment rate is declining, and so not too surprising, jobless claims are looking pretty strong right now. Here's a quick look on the construction industry, residential and single family and multifamily. We've got two charts here. We've got on the left hand the construction pipeline. Now, home builder sentiment has weakened a bit, and I think a lot of it has to do with the availability of materials and the cost of those materials, lumber especially, and some aluminum and some of the other components that obviously go into making houses. But you see, at least from an activity standpoint, permits are up, starts are up, completions are a little bit off, and that's because of some of these supply chain choke points. But you can see the trend relative to historical average. And again, this takes us back to the global financial crisis, which was really, the genesis of it was a speculative bubble in housing prices. And so you can see that recovery does continue to move ahead, at least permits and starts. On the right-hand side, you can see the breakout between single and multifamily. This is a 3-month moving average, so obviously multifamily permits are moving higher. Both are moving higher, but really what we can see is that, particularly single family, when we're dealing with housing affordability issues, it's good to see that more inventory is coming on the market there. And to the point of home ownership and affordability, this is just one representation of that, and a couple of views of this. One, the Affordability Index, which is measured here under this graphics provided to us by Reuters, is a share of income needed for housing. And you can see, over the last 12, 14 years, again, going back to the global financial crisis, where that sits now. So prices obviously were higher then and decreased in the global financial crisis. Affordability was kind of in that 30-ish% level. You can see it meander there for many years, and then now it's back up to 32.9. So it's essentially where it was when it was on the decline in the wake of the global financial crisis. So obviously a share of income needed to buy a house is going up. Now, on the upper right is just kind of an insert here for first-time buyers. And so you can see the share of home sales going to first-time buyers continues to decline. So obviously not something that we necessarily want to see. It is a function of higher prices and just raw affordability for upwardly mobile professionals. But that is certainly something that has been in place since the pandemic. Here's a quick look at the U.S. Consumer Price Index. We got this data a week ago, but it's still relevant, obviously, because it's a February survey number. And we'll get the March survey number, next month. So that'll obviously be important to watch. But here, we've got the year-over-year number. The estimate was for 7.9. That's where the actual number came in at. You can see directionally that does represent a spike. Again, this is taking us back to 1984, so don't get too caught up in this in the gyrations, because this represents a long period of time. So obviously in the early 80s was the last time that we've seen inflation like this. And you can see in the core number 2, that number was also in line at 6.4% on an annualized basis. Again, relative to the trend line, I think it goes without saying that we are ahead of that trend line. Here's a quick look at the components of that inflation. We didn't have a chance to go through this last week because unfortunately we didn't have a charts of the week because my laryngitis, but obviously back in the saddle this week, and we can kind of take a look at it now. And I think services. Really, it's a broad-based push here. Whether it's food, goods prices are going up. Energy is certainly going up, and there's broad participation here in this inflationary impetus. So it's not just one sector that's getting us kind of crossways here with inflation. It really is a broad-based influence. Well, this is a busy slide, and what this represents on the left-hand side is really the language of the Fed statement when they raised interest rates. And I'm not expecting anybody to read this. I kind of threw this in here for, I think, some degree, some shock value to see just how incredibly intense people are in parsing through the inflection points on this. And so the Fed has a blanket statement, and so for the people that don't follow this very much, a lot is made over how these statements are adjusted and rewritten and whatnot. And you can see these revisions, the cross-outs and the add-ins, and on the right-hand side is just a quick summary, actually from Daily Shot of what this represents on the left. They raised rates as expected. And the rate projections were hawkish, meaning that they are expecting to continue to raise rates. And they acknowledge broader price pressures, and you can see that highlighted in that first paragraph. Russia invasions increases uncertainty, but puts upward pressure on inflation. So, we clearly saw that statement be inserted, and then rate hikes will continue. So, I think the Fed has been pretty steadfast in their interest in wanting to telegraph this. In fact, as we'll see in a moment, it has really manifested itself in shorter term interest rates already, which I would argue has actually done some of the Fed's work for it. But we'll see that. Before we leave this slide, one other important item was the balance sheet. This is actually where the Fed has been buying treasuries and other securities on the open market to inject liquidity into the market. And so, a big question is, where is that going to go? And so clearly, the balance sheet runoff, where they could let items, securities on their balance sheet mature and just roll off and not be replaced, or whether they're going to outright sell securities to draw liquidity out of the market. Don't think they're going to do that, but I do think that they'll be more than passive in working to reduce the size of their balance sheet. Here is another busy chart, and there's two things on here. So on the left-hand side, we have the implied Fed funds target rate at various points, looking into the end of 2022. Now, obviously, this starts off in 2019, but it was an estimate then of what the future interest rates, short-term interest rates, were going to look like at the end of 22 at that time. And of course, we go through the pandemic and the expectations fell to the floor. And just we've seen here really in the last 6 months, that expectation really move higher. But it is all over the map. And you can see a pretty wide dispersion of estimates here, kind of coalescing around 2.25% by the end of this year. Now that's a market forecast, and it also incorporates the Fed's own estimates in that as well. Now on the right hand side, you can kind of see this, what we call the dot plot, which is where those estimates are at various points in time. So not only 2022. But looking out over the next several years. And what's interesting here is that, even though we may be, around 2.25% as the mean here for the end of 2022, it shows further rate increases by 2023, but basically by the end of 2023, rate hikes are done. And again, this is the Fed's own dot plot, which I'll argue, the Fed has not, necessarily been right all the time in this exercise and in predicting inflation and interest rates. But at least by their estimates, that they'll be done by the end of next year. And when we get into 2024, 2025, then they might be decreasing rates somewhat, and obviously that would be driven primarily by a slowdown in the economy. Well, here's a quick look at the U.S. 5-year break-even rate. So what this represents on the left-hand side is essentially the 5-year Treasury, the difference between the 5-year Treasury yield and the 5-year Treasury inflation-protected security. And right now, the implied inflation rate has moved considerably higher, and that's what this chart represents. The implied inflation is now moved higher to around 3.5%. And again, that's a short term. That can be quite volatile. Right now, obviously, we've got a lot of inflation in the pipeline and a lot of uncertainty related to energy because of the Russian-Ukrainian situation. And then kind of going back to the prior slide, on the right-hand side of this, you can see the market's basically pricing in another 6 rate increases between now and the end of this year. So this is a chart I kind of alluded to in some respects, but 2-year yields now basically are 1.92%. The 10-year Treasury is now trading at 2.1 or 2.2%. And so, we've already seen 2-year yields rise quite a bit, and much more so than prior rate tightening cycles, which are depicted in these other bars at 2015, 2004, 1999. And so we're now at that black line represents the current environment, and that zero represents this past week when we finally got a rate increase. That's the zero boundary. So 2-year yields leading up to that first rate increase have increased considerably more than we've seen in any of the prior 3 rate tightening cycles. Wage growth tracker, I don't think it's any surprise with a tight labor market, you're getting wage inflation. You can see that here on the left-hand side, kind of that most recent spike, which is something obviously we're going to have to watch. Now on the right-hand side, you can see because of high inflation, even though you're getting wage growth, your real wages are actually falling below trend line right now. Because you subtract out the impact of inflation, and those real wages are not growing as much as they would. And you can see here it's actually below this multi-year trend line. And so again, inflation, moderation, and activities of the Fed, and how they nuance this without raising too much too soon is going to be real critical in this. And I think it. Obviously you want to be somewhat measured if you're the Fed and not, blow up this popsicle stand. But at the same time, you want to make sure you get after it a little bit and that you're not falling behind even further. A little sobering look here, and again, it's not a surprise to any of us. I mean, high inflation can typically lead to a slowdown. Now that doesn't mean a recession necessarily. It just means a slowdown. Slower growth is manageable, at least from an equity standpoint, and it's proven that the investment markets can still function reasonably well, not robust, but reasonably well at a period of slow growth, as long as there is growth. But you can see the relationship between the Institute for Supply Management, the manufacturing index here, and the U.S. PPI here, which it's an inverted and kind of moved forward 18 months, this data would tend to suggest that we're apt to see a slowdown, which is in part why we see on that dot plot for interest rates, looking out into 2024, 2025, that there is a possibility of actual rate decreases. And talking about Russia and Ukraine and pulling 4 million barrels of Russian crude off of, at least the global developed marketplace here, and we're in the midst of a price shock for oil, even though oil is off its peak, but, we're still at elevated levels. And so when we've seen an oil price shock, there is a relationship here between high oil prices and recessions. And I don't mean to show this to scare you, just to say that that it does sometimes coincide, and it doesn't necessarily, overlap in real time. Although, sometimes it's a causal factor, sometimes it's related to other things that are themselves causing a recession. Like inventory bubbles and things like that. But there is a relationship, and I think we've got to respect that. And obviously, this is something that we're watching to see, how we get moderation. If there is going to be more crude put on the market. And we've got a slide coming up here too, next one, in fact, that will show us that we typically get more capital investment, and you're beginning to see some kind of patriotic impulses, so to speak, with the removal of Russian crude on the part of some of these domestic drillers who have been really, really financially disciplined over the last year or so, just because in prior up cycles where prices move higher, you've seen a lot of profligate spending and really a lot of bad investments that, when oil prices crater, then those businesses basically shutter and just go away. They're not durable, they're not sustainable enterprises. And so we've seen a lot of discipline here, and we might as well go ahead and transition to that slide. So, again, when times are good in the energy industry, prices are high. Obviously, that more provides more of an environment that inspires more development, more capital spending, and clearly in these blue areas, you can see that if you look at the current situation, 2021 we didn't see a lot of capital spending. U.S. frankly wasn't the swing producer in oil. OPEC kind of took that mantle back for some degree, and then now we've got Russian crude that's off the market. So here you've got this assessment for 2022, which on balance is not good because you get demand destruction, you get consumption moving down. Higher prices promotes less driving, promotes less gasoline sales, so on and so forth. And gasoline obviously is just one distillate product from crude oil. Obviously, you've got kerosene, you've got other types of fuels, and ethylene, which goes into making plastics and things like that. Well, continuing on this theme of where we are now and the sentiment that's out there. I mean, we're sitting at the confluence of a lot of different factors that don't seem to feel good to us right now. So not too surprisingly, in revisiting some of these charts on surveys, particularly fund managers, and again, some of these, I want to caution, some of these can be actually really good contrarian indicators, to be honest with you. But right now, you're seeing more stagflation fears begin to crop up, and you can see that here in this chart. Excuse me. Now, you've got an increasing number of fund managers that believe that we're in kind of the later stages of a cycle, which is kind of hard to believe because it just felt like we just entered a new cycle. And primarily because the last recession was so brief and it was really pandemic and shutdown driven. But you can see at least the fund managers, again, when they start to think late cycle, they tend to get a little bit conservative, and oftentimes they'll miss a lot of opportunity in the process. Manufacturing numbers. Here's the February survey for the ISM, and you could see it was actually positive. Now we've seen some tepid numbers overall over the last handful of months. The estimate was for 1% growth, and we actually got 1.2%, and that was positive. And then on the right-hand side, which I think bodes well for capital spending, is that you've got capacity utilization that is getting close to, if not attaining, a new peak, the prior peak of which was in 2018. And usually when you get high utilization, that inspires companies to want to spend more to add new capacity and in anticipation of further growth or to maintain productivity. In a lot of cases, you've got companies that are using CapEx as a way to modernize and introduce more robotics and automation and things like that. Retail sales, we were talking about this earlier. So on the left-hand side, you can see that number looks fantastic. And again, it's no surprise, post-pandemic, we know consumption was really strong. Retail sales were strong, and that has actually continued. And what's interesting is that's continued despite the inflationary push. Now you see that little slight tick down in the last data point for retail sales. It was slightly below expectations, but as you can see here on that trend line, it looks really strong. Now, granted, when you look at that relative to the rate of inflation, it doesn't look as good. Again, in the light blue on the right-hand side represents real retail sales. It's like the impact and the trend line of retail sales if you subtract out the the impact of inflation. And that actually does tell a different story. And so that's another reason why it's really important to get our arms around inflation. The components that are more transitory, that will tend to kind of, once the Ukrainian conflict is, at least reach some interim level of resolution, you'll see some of these areas kind of work themselves out. And then other areas, I think we're just going to have to contend with, and it'll be kind of a part of the fabric, so to speak. But here, we want to make sure that we're not losing sight of the fact that real sales are also important. And here's a breakdown of the retail sales, and you can see, not surprising at all, gasoline stations, food, and some degrees miscellaneous stores, but food and energy are the key drivers of these retail sales right now. And if you look down the sliding scale here, then you get into more discretionary items, which are actually in negative growth now. So home furnishings, electronics, appliances, and then non-store retailers. You can see that. So here are your drivers right now of the retail sales basket. As we talk about commodities, there's so much you can talk about. Here, is really just a few industrial metal categories that are obviously impacting a lot of things, from the housing sector to autos to technology, some degree. You've got, on the left-hand side, you've got aluminum and nickel. And this represents inventories. And so, when you talk about production, obviously Russia is, a reasonably stout aluminum producer, but inventories are overall low. And so the headline of this chart from Bloomberg is just that, when you get this environment, there's just an increased risk of a price shock here. And so I just say, just in general, that these inventory levels for a lot of different categories have helped to contribute to high prices right now. On the right-hand side, you have steel prices, and you can see what's happened to steel prices as of late. And so, again, cost inflation, availability of supply, all factor into this. Now, when you get into the out years, 2025, 2026, here you can see that the estimates are going down, but interestingly enough, the estimates are not getting that back down to pre-pandemic levels, as you can see in the stair step of the red here on the right side. Real returns amidst periods of heightened inflation. This is a chart that I pulled out of some research from FS Investments, and again, these are real returns on different categories. The orange bar represent Lehman Brothers, the Barclays Aggregate Bond Index. And again, this is a more price-sensitive index. You can see when, in the blue, the black represents the S&P 500, and the blue dots represent inflation on the right-hand scale. And so when you see, like in 1998 to 2000, inflation was about 5.25%. You actually had a positive response, and equities and bonds were down. You get into 04, 05, we had slightly higher inflation. In that case, it was about 6.25. You had really flat equity performance, and then bonds were down a little bit more. You get into 06, 08. Obviously, the global financial crisis, you saw a fairly strong hit to equities at a time where price inflation was relatively high, kind of above 8%, and then in that case, both bonds and stocks broke down, and that was that was amidst a global financial crisis as well, where the solvency of financial institutions was in question as well. And then 2010, 2011, you can see the impact there, where bonds were actually positive. Inflation was less than, but we had such a strong rebound not unlike what we've had up until recently, a strong rebound, and then we had a market correction to bring valuations down. Here's a quick overlay of the S&P 500 index, the chart I was going to include last week, so it's about a week old. So we don't see in that orange line the benefit of the uptick for this past week. But the relationship, I think, is still interesting to look at. That you've got in the white line, you have operating margins for S&P 500, and you can see, here in the white line that crested and kind of rolled over a little bit, but you can see that there is, a positive relationship there. It's not a really strong correlation, but it is interesting to watch that, obviously you tend to have positive equity performance when your operating margins are moving higher. Now, the big question is with the inflation basket picking up, how does that bode for equities if we're going to get some softening in operating margins? And obviously the big question on operating margins is, clearly producers are witnessing higher input costs. Now, are they able to pass those costs on to the end customer? And so these are all kind of, second order but related questions that will need to be answered here in the coming weeks and months. Here is the earnings revision index from Citigroup. You can see that analysts here are become a little bit more circumspect, I should say, in the estimates and the forecasts. You can see earning revisions have really kind of moderated as of late, which I think is a really good thing, because I'd rather see them become more pessimistic and then have estimate or have actual performance come in ahead of expectations as opposed to the other way around. Again, an interesting quick check-in here on that. Here's the equity risk premium as defined by the earnings yield of the S&P 500 less real cash rates. If you look at the equity risk premium, I mean, it's really spiked lately. And so equities here, by this measure, again, this comes to us from Longview Economics and Macrobond, shows that equities are, cheap relative to cash. I thought that was kind of interesting because we have seen from a valuation perspective, particularly if you look at the equal weighted S&P 500 index, that we're back down still very close to long-term averages in that area. And here's bond index total returns, and just looking at the categories. So not all fixed income is created equal. We have looked at high yield. We put some money into high yield. We put some money into leverage loans, and we've really tried to stay away from treasuries. And if you look down the scale, the parts of the bond market that have really gotten tagged negatively have been the longer duration, the longer maturity treasuries, and the sovereign bonds as well. So emerging markets, mortgages have been beaten up a little bit. Now I think we found perhaps a little bit of value in mortgages since they have been beaten up a little bit, but you can see high yield is actually performing very well. And here's the homebuilder optimism index that I showed earlier. I should have included this with the residential, with the building permits and that data earlier in the pack. But you can see that, again, supply chain choke points, cost inflation, these are things that weigh on builders, and it weighs on their survey of what, type of, inventory they can put on the market here in the coming 6 months. Import prices continue to be high. We have seen some areas of moderation in the supply chain choke points, but clearly we're still seeing more inflation in the pipeline here. And I wanted to show this as kind of a closing slide. So as we continue to read the really sobering headlines and really just the tragic humanitarian crisis in Ukraine right now with the unconscionable actions by the Russian military. Obviously this has had a very deleterious effect on Russia's financial situation, if you include the impact of the sanctions and whatnot. So two charts here to kind of leave you with. One is the left-hand side is a price chart for the Russian Federation sovereign bond. It pays 5.25% and it's due in 25 years. You can see at one point it was a highly desired bond, particularly through the last 5 years, and even after the pandemic was trading about 20%, 25% above par. That now has obviously changed, and at one point last week, this bond was actually worthless, and there was no secondary market for it essentially as well. But now we pick back up. But you could buy a 5.25 Russian Federation bond for about 21, 22 cents on the dollar right now. Not that you'd want to, but now having said that, though, I did read in the reading this weekend that Russia actually did make good on its most recent dollar-denominated bond, so that they have not gone into technical default on that yet. Right-hand side, Russia's most important export partners, and again, as we've talked about before, Europe is somewhat beholden. U.S. much less so, only 3% of all exports, and export volumes in billions, only about 13 billion. So not a big impact to us, much more so to Germany and Netherlands, and a lot of this happens to be energy too. So I think we're going to have to watch the European situation. I think that's it's fair to say that Europe's going to have some growth challenges as related to this. Production, supplies, and inflation. Mostly supply issues that can't be easily rectified overnight. But I can guarantee you that in all of the state houses and parliaments all across Europe, that people are very actively talking about all this stuff right now. Well, that's all we've got this week. Hope you've enjoyed the slide deck. It's good to be back on Charts of the Week. We'll be watching things very actively this week, particularly on the Ukrainian situation, and we'll be back to you next week with more charts and data. Have a great week. Talk to you soon. Bye.